Good morning. This is Teddy Kickstart from Forex Trading Unlocked, and we are here this morning with a Forex market breakdown for you. And what we're going to do first is look at our disclaimer, which just basically is letting you know that this webinar is for illustrative purposes. And then here is the Nadex disclaimer, our sponsor for today's webinar. Take a look at that, please, for a second. Just as basically says the same thing, that this is for educational purposes only. Okay, well, first we're going to talk about the fundamentals that are impacting the Forex markets over the next few days. So today we have, for the US dollar, we have PMI, ISM, and the crude oil inventories. And the euro and the Japanese yen will also be affected by the crude oil inventories. And we'll talk about that as we look at each individual market. Also tomorrow for the euro, you have the Eurozone employment numbers, and the US dollar, we have the jobless claims. And then on Friday, we have for the euro, the German industrial production, and also the US dollar unemployment and consumer credit numbers. So these numbers will definitely be the numbers to look at as the days unfold over the next few sessions. And especially for the US dollar, because the US dollar over the past like half a week has basically started to fall back. Now, the dollar, as everyone knows, has been very, very strong. The dollar index just keeps on pumping and pushing through resistance. And the other major currencies, even though their economic numbers haven't been so bad, just have not been able to gain against the US dollar. They've been under pressure for months. And that's in the midst of the tariff talks and all the other issues that are going on in the news. So now the one thing that we really want to look at is, are these numbers going to fuel the US dollar, or are they going to be more impacting the other currencies? So let's take a look at the charts and we'll start to look at these things. So first we have the euro US dollar. So the euro US dollar over the past almost week has had an explosive move to the upside. At least that's the way it looks on the chart. Now, the chart, you have to look at this little elliptical range. This is what is going to be our target trading range over the next week and a half to 2 weeks. So now, like I said, this bull market here over the past, or bullish rally over the past few sessions looks very extreme. But if you look at the actual numbers, the volatility, it's really not that extreme. The euro US dollar has been basically in a $4 range for the past 6 months, and especially over the past 2.5 months, it's basically been in a $2 range. So that being said, it looks really big because the volatility is so low, and it's been happening over such a long time frame. Otherwise, if you spread this out and you look on a weekly or monthly chart, you would notice that this is actually a very tight range. So that being said, this move is not something that's an exacerbated rally. It's not something to be looked at as a very bullish move. It's more of a multi-session daily type of move that we're looking at right now. So the biggest thing is to look at that downward sloping blue line. That crossed right there. The market rallied above that and has settled for the past 3 sessions. Also, at that same point where the market broke out, you see there's a yellow pivot point line. That is a major monthly and weekly pivot point. So the fact that that pivot point, as well as that downward sloping resistance line, crossed right where the market broke out, that's a significant signal. That usually means that there's a lot of momentum, especially for obviously buying momentum in this situation. So the question is it because of US dollar weakness, or is it because of euro strength? So the one thing that's happened over the past few sessions, that the numbers, the economic numbers, going back to fundamental issues for the Eurozone, have come out better than expected. So then better than expected, meaning in a way that favors the euro. Sometimes good numbers don't mean that the dollar or currency is going to go up. Sometimes they go down because of good numbers. But in this case, these numbers impacted the euro as far as giving it strength. At the same time, we have the US dollar, which over the past week has had certain fundamental issues that have come into play that have given it a reason for the US dollar to weaken. So at that time, so you have both currencies working in that direction. That means that is fueling this rally in the short term. And that's what gets us back to these numbers, especially the oil number that's coming out. The oil inventories have been pretty much not meeting the expectations, especially last week rather, the bills were much higher than expected. Now, this is a good thing because if you've been looking at the oil market's been breaking for the past week and a half, 2 weeks. If you are at the pumps, if you're going to drive a car and you fill up, you've noticed for sure the price has gone down for oil, or for gasoline, excuse me. So this break in the oil prices is definitely influential in impacting the euro as well as the US dollar for many reasons. It's bad for the dollar in certain reasons because it's a petro dollar. But for the euro, it's good because the cost of, especially for in the Eurozone, the price of gasoline is very, very expensive. It's more than twice what it is for the average in the US. So if something like this, when the oil breaks, that's a big impact for the euro and the US dollar currency cross, because the euro usually gets a lift when the oil gets a break. So these fundamental factors are probably what has driven the explosive move, which, like I said, is not that explosive, but since the range is so small, to have basically a $1.50 move in the euro all of a sudden, where that's actually a big deal. So what you'll see right now in that ellipse, there's the T1, T2, and T3. So the high from yesterday, that's our T1. That's a critical high that actually was taken out just a little bit earlier this morning. So that means that the market still is very bullish and it's trying to pressure this resistance. And I would say that most likely you're going to see it come up to this T2 and the T3 target area. So, and that's probably where you're going to see if this bullish momentum, especially if the numbers come out favorable for the euro and conversely negative for the dollar, that this is probably the pivot points that you're going to see the market gravitate towards over the next few sessions. Now, if you want to look at for support that's critical, especially to look as a risk level, is where the breakout point occurred. That's why we mentioned earlier that yellow line where the downward sloping blue line intersects. That level at 111.85 would basically be your critical support for any bullish risk. Also, conversely, if you're bearish, that would be an area where if the market breaks below that, it's probably going to start to head back towards that upward sloping blue line towards the bottom of the chart, which you can see is the rising bullish monthly support. And that would be an area where you would probably find the market bounce again, because the euro US dollar has been just trading in this range for a while now. And that could be the thing that happens here, is that don't be overzealous if you're a bull, and don't be overzealous if you're a bear, because it's very, very likely that the euro US dollar, in the wake of still dealing with the Brexit, as well as the tariff wars that are going on, is probably going to just be pushing the upper and lower extremities of this trading range. So that being that being said, key off that pivot and look for the T1, T2, and T3 to be the upper extremes of any surges to the upside. Most likely you're going to see over the next couple of weeks, even after the numbers come out, that this is going to, in this big elliptical area, that's going to be your range, basically from the 111.85 area up to about the 112.5 to 113 area. So let's go on to our next slide, which is the US dollar JPY. Now this is a monthly chart. As you can see that the market has been wedging over the past basically 4 or 5 years, and it's coming down to a needle point there. You can see that on this chart here that there's this line in the middle of the chart where the two blue lines intersect. You see this breakout timeline countdown point. So when you use it on a technical basis, when you have a market wedging, usually when the support and resistance slopes intersect, that's usually a time for a breakout. It'll occur by that time. So obviously that is still not until August of 2020. So that's far out, that's over a year to go. So now let's look at this wedge here. So the Japanese yen, it's trading here just above the 108 area. And if you look at this range, these pivots, the two yellow lines, that has been basically the range now for over 2 years. And I would say that most likely, especially with the tariff wars that are going on, and its other issues, that this is going to be the range for the US dollar Japanese yen to come for the next few months for sure. But you can see the downward sloping resistance and also the upward sloping support from the lines that come into that ellipse. If we can get the market to move above or below those lines, then we would probably see a move towards one of those upper pivots. Now, the oil inventories that are coming out today, and especially the price in oil, you can see that the US dollar yen has been under pressure on this monthly basis. Most likely this has been because of the oil per trade. Oil is a very tight commodity for Japan, and the price of oil definitely has a big deal influence on their currency as well as their markets. So the decreasing price of oil over the past month is definitely a fuel to the Japanese economy as well as to their currency. So that's probably why you're seeing the bears winning this tug of war in this range trade. But once again, this market is in a range trade. So right now it looks like the bears have the momentum, and support is where you're going to look for the market to gravitate towards right now and keep on prodding that, especially if the oil inventories come out very strong. This is a very good thing for obviously everyone globally. The price of oil means cheaper gas, but it definitely is good for an economy or for a country like Japan that is very reliant on its oil imports. So that being said, we would like to see most likely higher inventories, which would be adding fuel to the fire for the US dollar yen break that's going on right now. So once again, this move also would be because of dollar weakness, most likely more than Japanese yen strength. But in this case, the oil, because it is such a crucial variable, that probably means that the yen will probably go offer more than bid if the number comes out positive. So that's probably going to spark a nice little move later on today. But once again, this market is in a range-bound area and probably will be for months to come, especially as the tariff wars continue. But that is something that is leaking out into news as well. That we've talked about this for months, that the one thing that's been positive about the trade wars that are going on is that while China is suffering, the rest of Asia is not, and it's come out recently that the numbers in Vietnam, Taiwan, as well as Malaysia, Chile, Argentina are exploding because of the tariff wars that have been in place. So markets correct. I mean, when the trades markets, especially in the financials and especially agriculturals as well, would know that we've seen lots of volatility, and a lot of this now comes because of these trade wars where markets correct, there's an imbalance, where an imbalance occurs because of the arguments between the US and China, or the US and Mexico, or whoever it is the tariffs are being argued against. Then other businesses will look for other sources, and they look for them very quickly. So I think that the lesson can be learned from 2008 when the economy slowed down in the United States, where it brought China to a standstill. The tariff wars are doing a similar thing, just not as quickly and as harshly as it was when the economy slowed down. So we'll see what will happen. The G20 summit is coming up towards the end of the month in June. And as well, it's also happening in Japan. So we're talking about the US dollar yen trade. So that's another thing I would look to see, the US dollar yen probably be steady and trading in a narrow range over the next week and a half to 2 weeks. But if the oil inventories, like I said, come out strong, then we probably will see the US dollar yen continue to erode. And the bears would be the winners of this tug of war battle that is going on right now. But look at the two yellow lines for your pivots. That's most likely the range bound extremes. The elliptical area is where we're looking now. This is a monthly chart, so this is looking out for the next year. So the range is not that extreme, especially when you look at the chart. It's just narrowing and narrowing and narrowing. But we'll see what happens over the next few months if we can lay down on support, or actually something turns around and the dollar gains strength against the yen. And that might be the thing that would get you a major move, would be is there's some change in the US dollar. But once like we started at the beginning of this webinar, is the dollar turning? So with the way the euro is looking right now, which is a major currency in the dollar index, that is definitely making the dollar negative. Now with the US dollar yen, in this situation too, even though on the month right now it's only slightly lower, it is leaning on support, which that's also pushing the dollar index lower and the US dollar lower. So, and the US dollar yen is one of the major currency crosses, not as much weight as the euro or the pound, but the Japanese yen definitely has its bearings on the currency. So with that being said, let's move on to our next one. And that would be, we're moving to the other side of the world, to the British pound US dollar. And there is a lot going on with the British pound US dollar trade. So this one here is a daily chart. However, we have monthly and weekly things going on this chart. As you can see, there's a lot of little things going on, lines and boxes and whatever. So let's start with the yellow line. That is a 0.32 Fibonacci level and key monthly support level. So that is our pivot that right now for the bulls, we are looking to gravitate towards. The market has been bullish for the past few sessions. And ironically, it pierced just below the weekly support line that has been on the, if you look on a weekly chart, has been going back for a very long time. So that was, it held, just barely got through that line and then bounced. And right now it looks like it's very strong. And with, like we talked about the euro US dollar and the US dollar yen, the dollar is weak right now against major crosses, and it's also showing in the pound. Now the pound, like the euro, is one of the major influences for the dollar, or against the dollar rather. So this rally in the pound, even though it's not that significant, definitely has its weight as far as keeping the dollar at bay. So while the other currencies are moving against the dollar and the pound is going against the dollar, that's why we've started this webinar saying, is the dollar turning. So I think right now the moves you're seeing in these crosses is dollar driven, which means dollar weakness driven. And as our numbers come out today, the oil number, once again, if that impacts the dollar and weakens the dollar, then you'll probably see a surge to the pound once again later on today, pushing newer move highs. Now the key thing to look at, like I said, is this Fibonacci level. That's the first target to the upside that we're looking at. And then above that, we have this reddish kind of line right there. That's another Fibonacci level, which is the 50% level from that last previous high to this low that was set a few sessions back. So that would be another extreme rally point to look for if the bulls really start to press and move. But this would be, this is a daily chart, that would happen probably over the next course of a week or so. So this is not something that's going to happen today or tomorrow, but would unfold over the next week or so, especially if the dollar is under pressure because of fundamental numbers and things like that. So those two green lines, those are our weekly support and resistance lines that are wedging this market as it's, which is in a bear market right now, short term, trying to find a little bit of a bull to go. Now the blue lines, which are in the corners of the charts, the upper and bottom right side, those are monthly resistance and support lines that are backing up the weekly lines that are coming down. So this market has been wedging on a monthly basis and a weekly basis, and obviously we have going out for the next 4 to 5 months before we're going to actually start to really test those levels on the monthly basis. But the fact that the weekly support held and bounced a few days ago, that would be a nice little indication that this market, even though it's in a bear market, has hit the lower part of its channeling lower. So right now we're probably going to see a sideways trade to potentially higher trade, hitting, like I said, targeting at that 0.382 Fibonacci level at $1.2789. And once it gets to there, then like I said, if the extreme rally happens, look for it to push to that 50% level. But otherwise, most likely that's about all the gas it's going to get. And the reason I'm saying that is that the move currently in the pound dollar, just like the other two currencies we spoke of, is driven because of dollar weakness. So dollar weakness means that as long as dollar weakness prevails, then the pound dollar should have to keep on maintaining the trend higher. But if it's dollar indicative, then for sure any type of strength to the dollar will make this market turn back towards support and turn back very harshly. Looking at this chart, you can see that the market inches higher and gravitates towards pushing resistance, but then when it starts to sell off, it starts to hit the market hard, hit support hard, and then you have multiple consecutive days of lower trading. So that being said, this market, even though it's short term showing strength, it isn't a bear market. So keep that in mind for anyone that's trading the pound US dollar. Another thing that's happening, over the next couple of weeks is we have the G20 meeting. Now, the G20 meeting is going to have a lot. Obviously, it has world leaders talking about financial issues that impact the economy as well as their own countries. The biggest dog at the table probably will be the United States, because we have the tariff war with China, so both sides are going to be represented at the table. And at the same token, we also have the UK and the EU that's going to be there, which will be, obviously, Brexit will be something that will be brought up. And the US tariff wars also impact both the EU, the UK, as well as all the other countries. So that being said, the dollar probably, as we get closer to the end of the month, will start to fall into a very neutral trade, just because there's going to be a lot of expectations and more rumor and speculation than anything until we come down to that meeting, which was, I believe, is on June 28th and 29th. So when we come to that at the end of the month, as we approach that time, you can probably see a narrowing of the trading for all of the currency crosses. So like we've already been looking at the market wedging, you look at a market like the Euro US dollar or even the US dollar yen trade, those two markets especially will probably get very, very tight 2.5 weeks from now. So any movement in volatility would be that you want to try and take as an opportunity would probably occur over the next 1.5 to 2 weeks. So that being said, since we have the market, the US dollar weak and the other currencies trending against it, the trend is your friend. So for the bulls against the dollar, keep your stops tight and work that side. And for the bears, get ready for a potential reversal very quickly, because there's not much volatility that's going to drive these markets to any extremes right now. The world is looking at what is going on with the tariffs, and we know that especially between the US and China, they basically have said, well, we'll be talking at the G20. So everything that's going on beforehand is basically just a little bit of fluff between the ambassadors of both sides. And then we have also what's going on with the UK and the EU, Brexit, what's going on with the change in leadership since Theresa May is stepping down. That's another thing that right now is this pound dollar move, a reaction because of that. I don't know. That's a hard one to call, because the proof is in the pudding. So the change in leadership, there's some things have to happen before you can say that the new leadership is the reason that they're getting strength in the pound. More likely it's dollar weakness. So, and that's where I would keep my focus until we start to see action from the political side going on in the UK. And we'll see what will happen, especially in the G20, because that'll be the time for the representation to step up. So once again, with the oil numbers that are coming out, that will impact the pound dollar trade as well, because of the dollar influence. And I would say most likely if the builds come out very positive, or especially if they beat expectations, but you'll see a little bit of a pop again in the British pound US dollar and see resistance being tested into the afternoon session. And then as far as the next couple days or into next week, like I said, we're most likely going to see the dollar continue its weakness, but not beyond that. Remember, with the G20 meeting, this would kind of set up this reversal of the dollar right now. If the trend continues for the next week or so, that would be about the extreme, and then that would be the time for the dollar to gain a little bit of strength, and then basically put all the major currency crosses into a sideways drift into the end of the month. So unlike a lot of summers where you get a sleepy trade because the markets are just falling asleep because everyone's on vacation, I think that we're going to develop a summertime sleepy trade, not this week and not next week, but into the end of the month as we head into the G20. And that's because all the fundamentals are going to be, even in the numbers that do come out between now and then, they're still going to be looking at what is going to happen out of this G20 meeting. Is the US and China going to finally come to terms? Is the US going to come to terms with anybody, to be quite honest with you? And not that it's a bad thing that was going on or a good thing, it is going on, so it is impacting the markets. And once again, it's causing dollar weakness, but remember that the dollar has been so strong for so long that just because the dollar is coming back right now, especially over just a few sessions, you're talking about coming off highs. So the market doesn't trade in just one straight line. So dollar weakness right now by no means means that the market is turning and the dollar is a bear and that the other currency crosses are now bullish. They are short-term in the corrective mode. That's the way I would look at it right now if I was trading any of these currency crosses, depending on how you're trading them, whether you're putting on types of option spreads or what have you. So once again, look at this Fibonacci level, the yellow line. That is our key target level right now, and I think that that's when you're going to start to see the market run out of steam. That 50% level, which markets like the 50% level in all markets, doesn't matter what it is. So if we get in a bullish move that can really press things, I think that is definitely where you'll see the market run out of gas. And if you look to the left of where it says the Fibonacci 50% level, you can see that there was a low as the market was breaking before it had a little corrective move. So besides being a Fibonacci level, it's already shown that the market does like that as far as a support line. So that what is support also becomes resistance and vice versa. So as the market, if it does gravitate to it, that would be probably a good area where you'll see a bounce off of. But I don't see major momentum in the market fueling this rally, and especially, like I said, the G20 meeting coming up. So but the one thing that's kind of funny with the when it comes to currencies is that for so long there was always a question of the U.S. doesn't protect its dollar, doesn't do things to help its dollar gain strength. And irony of it all, we've done nothing to protect the dollar over the past couple of years, and especially the past year, and the dollar has just been a raging bull. So, and that's something that all you traders should be thinking of as you look at these currencies or other currency crosses that we have not talked about today, is that the US dollar, no matter what, the trend is your friend, and the US dollar is a bull. So if you're going to take the opposite side on any currency cross, keep that in mind, that any move that you're trading to the opposite, most likely in the short run, at least until proven differently in the longer term, is nothing but a corrective move. So use your head, use your money management, and keep it tight when you're trading, when you're trying to fade the US dollar. So, and once again, the technical aspects, we've given you levels to shoot for. The fundamentals are kind of foggy right now, which the markets, anything can happen. Everything's a new day is a new day. But the fundamentals right now are very hard to gauge because we don't know. We know what direction the different sides want, whether it's China, the United States, the EU, the UK. The problem is that no meeting of the minds is making anything really happen. There's no absolute decision on saying, okay, we're moving forward and we're moving forward this way. Right now we have a bunch of screaming kids at the table who are just saying, I want it my way, I want it my way, and we know that nothing happens when that happens. So, and we'll see if over the next few months, and especially from the G20 meeting, when all the leaders of state get together, if they can start to come to the table and just move on like adults. And that would be the biggest thing. It would help the world. It would also help traders. So we'd have an idea of what's going on fundamentally besides just looking at technicals right now. And that would be kind of interesting if that happens. I doubt it will, though. So once again, dollar strength still prevails, and right now we're just coming off of dollar highs. So that's what we're looking at as far as the weakness there. So key off your levels and keep your money management tight, and basically look for a nice little follow through possibly over the next few sessions, but then keep your eyes on the prize as we move into the rest of the month, because we're going to probably start to see a decrease in volatility. So always remember to do your homework, look at the markets, weigh the potential trades, and have a plan and stay the course in your trading. So I'm Teddy Kickstart, I'm president of Forex Trading Unlocked, and I will be coming back to you soon with another webinar sponsored by the Nadex. And if you want to, before that, check anything out that we have going on, you can find me at forextradingunlocked.com, and you can follow me also on Twitch, StockTwits, and also on LinkedIn to follow and find any information that we're putting out, as well as analysis that may interest any currency Forex traders and even traders of other markets, because there's always correlation trades. So sometimes what's going on in one will give you an idea of what to do in another. And also, if you like the analysis that you heard today, I wrote a book called High Probable Japanese Candlestick Patterns that's available on Kindle and paperback on Amazon. And if you read that, you can learn how to utilize the best buy and sell patterns used for over 400 years to give yourself a competitive edge against the markets. So with that, good luck in your trading. As always, keep your stops tight, keep your money management together, and your plans solid as well. Good luck, and thank you very much.